You don't need to hold dollars either that are being inflated away by $100,000 a second. 1, 2, 3, 4. That's $1 trillion every 100 days. 100 grand a second is being pissed away and bankrupting your grandchildren and my children and all of these people that are working their tail off right now only to be indebted by fiscal irresponsibility. So the dollar's days are numbered ultimately, as are the treasury. I do believe that. So as we talk about the gold revaluation account, to me, that's option number 4. You just revalue the price of gold as high as it possibly can go, legitimately, and write off your debt. On every balance sheet across the globe, the gold in central bank balance sheets is held in what's called a revaluation account. And it's weird. The way that they have the rules set up, I'm not sure really why they do it this way, but they have the gold in their balance sheet on the asset side and the revaluation account, which mirrors it on the liability side. The rule is you can't offset a liability with your gold. And for whatever reason, it's still valued at $35 an ounce across all of Europe, as an example. The Bretton Woods number. Now, I'm not sure. I used to know. I mean, it's been so long that why they moved the U.S. price up to 42.22. I don't remember exactly why, but suffice it to say, the official price in the United States is 42.22 on the books. You know, you got the head of the Dutch National Bank who keeps talking about this. He keeps talking about revaluing gold. I think I can pull up here really quick. I think, bear with me. I'm going to do this as fast as I can. I just read something today from it. He says, let's see, the head of the, his name is Klaas Knot. And in October of 2022, he is the head governor of Dutch Central Bank. He said the balance sheet of the Dutch Central Bank is solid because, make this bigger so I can actually read it, is solid because we also have gold reserves and the gold revaluation account is more than 20 billion euros, which we may not count as equity, but it is there. Now, it's interesting to understand that when we talk about the revaluation account, why do they give it that name, I guess, first and foremost? Why would they give it the name of a revaluation account if it wasn't something that they noticed? And it's option number 4, right? And option number 1 for the Fed would be to inflate, the way all governments have done. And option number 2 would be to default. Option number 3 I focused on for the last 4 years, and that was incite the world to no longer trust the United States, to no longer have a need to use the dollar for oil, to sign an executive order to go green, to stabilize the country, weaponize the dollar in the treasury market, and have everyone dump dollars. There's something called Operation Sandman that people should Google. Over 100 plus countries in theory, and I don't know how true this is or not, but Mike Adams sure thinks it is, and he's a smart guy, that they've all agreed at one point to flip the switch. And it would happen at night is the way that it's written down, the night of the switch, they call it, where in unison, they will all dump US dollars in treasuries. Now, if all of a sudden Project Enbridge and the unit token get ratified and it comes out in October, I mean, it is not beyond the scope of my imagination to see that come to fruition. The slowly, little by little by little by little divestiture of dollars and treasuries, which we have seen, is positioning. And the accumulation of commodities like gold, which has doubled the performance of the 10-year treasury for 25 years with no counterparty risk. It's happening. So all of these countries, and we're supposed to be, the United Kingdom is now going to be the biggest purchaser of our treasuries, along with Ireland and Cayman Islands. I got some oceanfront real estate to sell you in Minneapolis if you believe that that really is legit. It's not legit. I mean, Jim Willie says they're paying them under the table. I don't care what it is. One broke nation buying the debt of another broke nation is just not really smart. And it shouldn't be even considered an asset. But it is, and it won't be the way things are going. It looks like the way that if indeed the unit comes about and you don't need to hold treasuries because gold is outperforming it with no counterparty risk and will be the primary component of a new settlement currency, you don't need to hold dollars either that are being inflated away by $100,000 a second. 1, 2, 3, 4. That's $1 trillion every 100 days. 100 grand a second is being pissed away and bankrupting your grandchildren and my children and all of these people that are working their tail off right now only to be indebted by fiscal irresponsibility. So the dollar's days are numbered ultimately, as are the treasury. I do believe that. So as we talk about the gold revaluation account, to me, That's option number 4. You just revalue the price of gold as high as it possibly can go, legitimately, and write off your debt.
The intricacies of how central banks handle gold on their balance sheets are both fascinating and revealing. As Andy Schectman points out, gold is held in what's known as a revaluation account, an accounting method that underscores its unique status among assets. It's peculiar, almost ironic, that gold, despite its critical importance, is still officially valued at an antiquated price of $35 per ounce across much of Europe. In the United States, the figure is slightly higher at $42.22 per ounce, a number that has its roots in historical precedent but is far removed from the current market value of gold. This archaic valuation system is a relic from the Bretton Woods era, when gold was tied to the US dollar at a fixed rate. Despite the shift to a fiat currency system in 1971, this low official price remains on the books. But why? The answer lies in the potential future revaluation of gold, a concept that central bankers are well aware of. By keeping the official price low, they maintain the flexibility to revalue gold significantly higher in the event of a financial crisis, effectively using it to balance the books and offset liabilities. This is a key point that often goes unnoticed, but it's crucial to understanding the potential future role of gold in the global financial system. The fact that central banks even have a revaluation account should be a clear indicator that gold's official price is not meant to stay where it is forever. As Schectman mentions, Klaas Knot, the head of the Dutch central bank, has openly discussed the strength of their balance sheet being tied to their gold reserves, specifically mentioning the revaluation account. When a central banker talks about revaluation in such a matter-of-fact way, it's worth paying attention. This is not just about accounting, it's about strategy. Revaluing gold could be the most painless way for governments to manage their massive debt burdens. The alternatives, defaulting on debt or inciting a global financial crisis by undermining trust in the US dollar, are far more destructive. Instead, quietly revaluing gold upwards would allow central banks to offset liabilities, stabilize their balance sheets, and restore confidence in their currencies. This is not a wild conspiracy theory. It's a practical solution that has historical precedent and is likely being considered behind closed doors. The potential for a coordinated global effort to divest from the US dollar, referred to by some as Operation Sandman, is a chilling thought, but one that seems increasingly plausible. Schectman points out that over 100 countries could, in theory, flip the switch overnight, dumping US dollars and treasuries en masse. While this might sound like something out of a thriller novel, the groundwork for such a scenario is already being laid. Countries around the world have been gradually reducing their dollar holdings, increasing their reserves of gold and other commodities instead. This slow divestiture is not just a reaction to US policies, but a strategic move to protect national economies from the fallout of an overextended US financial system. As the US continues to print money at an alarming rate, $100,000 per second, as Schectman dramatically notes, the value of the dollar continues to erode. For countries holding large reserves of dollars, this is a ticking time bomb. The logical move is to diversify away from the dollar, and gold, with its centuries-long history as a store of value, is the natural choice. The decline of the US dollar's dominance in global finance is not just a possibility, it's a process that is already underway. The accumulation of gold by countries like China and Russia is a clear sign that they are preparing for a future where the dollar is no longer the world's primary reserve currency. This isn't just about speculation, it's about survival in a changing global economy. As Schectman notes, gold has outperformed the 10-year treasury for the past 25 years with no counterparty risk. This makes it an ideal asset for countries looking to hedge against the decline of the dollar. The potential introduction of a new global currency, possibly linked to gold, could accelerate this shift. If such a currency were introduced, it would render the dollar and US treasuries less relevant, further diminishing their value.
They were convincing in the way they did it by reversing the arbitrage situation with gold on the Shanghai Gold Exchange. Silver still is offering that arbitrage, but right around the end of July, we saw, in fact, COMEX gold futures were actually a little bit higher than the Shanghai prices. And that fell in line with what they were trying to do. And look, first of all, just to recap some of the things I've talked about before about this, before I tell you what I read about it really being false and evidence of it is that for my whole career, everyone said you can't believe what they're telling you. It's been known that they're the largest producers in the world, and they make or produce between 300 and 500 metric tons a year. You just add that up for the last 25 years, and you're well above the numbers of 2,600 metric tons or whatnot that they tell us. But most of my career, I mean, Donegan, I've been doing this for 34 years, and I can remember vividly most of my career, everyone saying the numbers that the Chinese are telling us, and usually it was stuck at 1,200 metric tons for, I don't know, for a long time. You can't believe it. They're not updating the numbers. You have the IMF saying their numbers are fugazi. You have the head of research for Bank of Montreal said their numbers are massively understated, and they are understated. They have been. Why would they want to be forthright? In particular, when we see the new unit settlement currency that has been evidently, according to Delma Rousseff, the head of the BRICS New Development Bank, agreed on in principle, 40% gold backing. Why would they want to be honest about how much gold they're buying? There was an article that I read, and I think it was from Koos Jansen. He's a hell of a researcher, and he said, because the bullion banks take care of the gold transport for the PBOC, the shipments from London to Beijing are disclosed in UK customs data. The customs data reveals that the PBOC continued to buy gold in May. When it communicated to the market, it discontinued buying at it. This is the thing. You can see the efforts they are going or taking, even going as far as decreasing the arbitrage premium on the Shanghai Gold Exchange to really make it look like they stopped buying it. But in essence, what did it do? It drove the price down. And the Western media, who's so stupid as it pertains to telling us what's really happening, well, they were all over, Reuters and all of the news channels were all over the fact that Chinese stopped buying gold, and that's got to be bad for the gold market. You never hear anything positive. It's always, even if it is positive, it's spun with a little bit of whipped crap on top of it for dessert. And they never, ever are bullish about gold because it is the antithesis of the system. So the media, after 18 months of the Chinese finally updating their numbers repetitively, and they stop, they're all over it saying they stopped buying. And I said, that's just a lie. I've been saying that on your show and everyone else. They're not stopping buying. In fact, these export numbers prove it. But I think people need to understand that this is an all-out rush. And when you see the effort that they are going to, like going through Latin America and paying double what everyone else will pay for unrefined doré in silver and silver concentrate to ship it home, tons and tons and tons and tons and tons and tons of this stuff, the cost of shipping it and refining it they're okay with that. They've been mining gold that has been very uneconomical for a long time using our trade imbalance. And so to them, it's money. And to them, they see the big picture. They think in terms of decades. Now, the BRICS has been going on for 18 years. This is not just a trend that is just beginning. And like you said at the onset here, things are spinning faster and faster and faster. I use that toilet paper roll analogy all the time. They are spinning.
Across the globe, central banks have been quietly accumulating gold at unprecedented levels. This is not just a trend, it's a strategic shift that signals a coming change in the global financial order. As Schectman explains, countries like China and Russia have been steadily increasing their gold reserves, often underreported or even concealed from the public. This accumulation is part of a broader strategy to reduce reliance on the US dollar and prepare for a future where gold plays a central role in international finance. The recent news about China allegedly downplaying its gold purchases while continuing to accumulate massive amounts is a prime example of this strategy. By keeping their gold buying under wraps, these countries avoid driving up prices prematurely, allowing them to amass even larger reserves at lower costs. This is a calculated move that shows just how seriously these nations are preparing for the next phase of the global economy. One of the most significant developments on the horizon is the potential introduction of a new global settlement currency, possibly tied to gold. This would be a seismic shift in the way international trade is conducted, moving away from the dollar and towards a more stable, asset-backed currency. Schectman mentions the concept of the unit token, a new currency backed by 40% gold, which could be used for international trade. If this currency were to be adopted by a significant number of countries, it would drastically reduce the need for dollars in global transactions. This would not only diminish the dollar's influence, but also boost the value of gold as countries scramble to acquire enough to participate in the new system. The implications for investors are clear. Those who hold gold will be at a significant advantage. The Bank for International Settlements, BIS, has already taken steps to prepare for this new financial order by reclassifying gold as a Tier 1 asset. This reclassification means that gold is now considered as safe and as liquid as cash or government bonds. It's a move that reflects the increasing importance of gold in the global financial system and signals that it will play a key role in whatever comes next. The BIS's actions are a clear indication that the current fiat system, dominated by the dollar, is on shaky ground. By elevating gold to this status, the BIS is preparing for a scenario where gold becomes a central component of a new, more stable global financial system. For individual investors, this is a strong signal to increase their holdings of physical gold. While gold often steals the spotlight, silver is also set to play a crucial role in the new financial system. As Schectman explains, silver is not just a precious metal, but an industrial one, essential for a wide range of technologies, from electronics to renewable energy. Despite its importance, silver remains significantly undervalued, largely due to the manipulation of its price by a few large financial institutions. However, as the global demand for silver continues to rise, driven by both industrial needs and its role as a safe haven asset, the price is likely to correct upwards. For investors, silver represents a unique opportunity to acquire a highly undervalued asset with significant upside potential. The time to invest in silver is now, before the market catches up to its true value. Looking ahead, the long-term outlook for both gold and silver is incredibly bullish. The current economic environment, characterized by high levels of debt, inflation, and geopolitical uncertainty, is exactly the kind of scenario where precious metals thrive. As more countries and investors turn to gold and silver as safe havens, their prices are likely to continue rising. In the short term, there may be fluctuations and even significant corrections, but the underlying trends are clear. The world is moving towards a financial system where tangible assets, particularly gold and silver, are at the center. For those who understand this shift, the opportunities are immense. In conclusion, the quiet accumulation of gold by central banks, the potential introduction of a new global settlement currency, and the reclassification of gold by the BIS all point to a future where gold and silver are central to the global financial system. For individual investors, the message is clear. Now is the time to increase your holdings of these precious metals. As the world transitions to a new financial order, those who are prepared will be in the best position to protect their wealth and capitalize on the opportunities that arise. As we navigate through these uncertain times, one thing remains clear. Gold and silver are the ultimate safe havens. They have stood the test of time, outlasting empires, currencies, and economic systems. By investing in these precious metals, individuals can ensure that their wealth is protected, no matter what the future holds. Remember, in a world of uncertainty, gold and silver offer stability, security, and peace of mind.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today. Link in the description.